Compound is one of the bigger DeFi protocols, and it's essentially a collection of interest markets. People who want to deposit some crypto assets and earn some interest can do so on this protocol. People who want to borrow some crypto assets and pay interest can also do that. And before I show you around the web app for Compound, I want to quickly give you a high level behind the scenes, a really simple behind the scenes of how the Compound protocol works. So first we have the C token contract. The C token contract, it's what integrates an asset to the Compound protocol. So an asset like Ethereum or DAI, and the C token contract is the mechanism by which you perform your various lending, borrowing actions. So you can mint C tokens through this contract. You can pay back your loan, liquidate a loan, etc., etc. These rules are specified in the C token contract. And let's zoom in on what are C tokens. So let's start with an example. So we have some Ethereum that we'd like to deposit. Let me put that down, deposit Ethereum. We'd like to earn some interest on it. And through an exchange rate, the Compound protocol gives us C tokens back. And C tokens is the generic term for the tokens that the Compound protocol gives you back for the assets, but for each asset you actually have a specific name. So for Ethereum it'd be C Ethereum. Let me write this clearer. C Ether, and we hold these C Ether tokens for some amount of time. Time passes. Dun, 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 dun. And then we want to take out our Ethereum again. We want to withdraw it. And there's also exchange rate here to exchange those C Ethers for the Ethereum. And one thing I should mention first is that these C tokens are ERC20 tokens. So all that means is that it's a standardized token format, and it can be used with third-party applications outside of Compound because it's standardized. So this is something to note, that this is using a standardized token format. So it's you can trade these tokens outside of Compound, for instance. So in this timeline of depositing, getting some C tokens, and then getting your Ethereum back, where are you earning the interest? Because that's what people care about. Where are their earnings? And something I want to make clear is that you're not getting more interest through getting more C Ether over time. The number of C Ether stays fixed, and instead it's actually the exchange rate. That's the exchange rate that's allowing you to get a greater amount of Ethereum back as long as the interest rate was positive. So this exchange rate is different from this exchange rate, and in most cases, and when the interest rate is positive, this exchange rate will be greater than this exchange rate, and it'll allow this quantity to be greater than this quantity based on factors like the interest rate. And this exchange rate formula actually has the interest rate baked in, and I'll show you that real quickly. So this is the exchange rate. This can be found on compound.finance/docs, which is the official documentation. And the exchange rate is on a per market per asset basis. So even though the exchange rate formula is the same, because the inputs to the formula are different per asset, the exchange rates are different per asset. And I'll explain what each of these terms in the formula means. Get cash is the total amount of the asset available in the market. So this is this can be seen as like Ethereum or DAI, and the amount of Ethereum available in the market. Total borrows is how much of that asset is being borrowed out, and this is the term that actually includes the interest. So this term gets bigger and bigger as it accrues interest. Total reserves is the amount of the asset the Compound protocol is keeping for itself for emergencies, and total supply is the amount of the C tokens in the market. So you can see how this kind of makes sense. Let's just say that there's nobody else depositing more Ethereum, so the total supply stays the same if nobody's depositing or withdrawing, so the total supply stays the same. And over time, though, this term grows, so this exchange rate gets higher, and therefore you're kind of accruing interest through this exchange rate. And similarly, you can see that if people were to store more Ethereum, then this term grows. So all in all, you can kind of see how this formula works to enable you to get your interest rate through the exchange rate. And just to give you extra peace of mind, we can take a look at the total borrows function. And as you can see here, this is the total amount of borrowed underlying with interest being the key part. So we're in the Compound web app now. It's just compound.finance in your web browser. And it's very sleek, easy to use UI. So first you'll want to connect with your wallet. It's really easy to do. You can pick a couple wallets, connect, and there are other ways to connect to Compound, but I'll just go over the simple, straightforward ways for this video. And here you can see the supply markets, borrow markets, and the various assets and the annual percentage yields, and how much your wallet contains. So these numbers are for how much your wallet contains, and the same over on the borrow side. The liquidity, you can see how much of this asset there is available in the market. So let's see how it looks when you want to deposit some Ether. So you click on the asset and you can see supply or withdraw. You specify the amount of Ether that you want, for instance 0.05, and then here's the interest rate for depositing this much Ether. Or it's not dependent on how much you're really depositing, but this is just the APY for Ether. And this distribution APY, this relates to the distribution of COMP tokens. COMP is spelled COMP, and it's the governance token of the Compound protocol. And they had launched a distribution plan many months ago, and people who are depositing or borrowing get COMP tokens because they want their users to have these tokens, because the token holders are the ones who can vote on decisions on how this protocol evolves. So you can see here, 0.46%. This is your interest rate for how much of this COMP token that you'll receive. And this COMP token also has value, and you can sell it on the market. I think currently it's worth hundreds of dollars, so it's quite good. And are your borrow limits, and then you just click supply, and you're all set. You should do some confirmations with your wallet, and then that's all there is to it. The same with the borrowing. Again, you have a borrow APY plus a distribution APY, and there's repaying, and this is how you repay. And then once you click once you take the action, you'll probably have to make some confirmation with your wallet, and then after that, you're all set. So here are some summary statistics on top. Supply balance, borrow balance, net APY. You can see this is just the amount of interest you've earned plus the COMP interest. This is the distribution APY I was talking about before. It's very easy to use. I'm now in the markets page of the Compound website. It's just compound.finance/markets. And I want to quickly cover something here. First of all, this is just some summary statistics: supply volume, borrow volume, the amount of supply and borrow in US dollar terms, and et cetera, et cetera. These details are pretty self-explanatory. But let's go into one of these assets, and I want to show you a cool chart. So here is the interest rate model, and it's utilization versus APY, and APY is basically interest. It stands for annual percentage yield. And you can see currently the utilization rate is just 4.73%, which means not many people are borrowing, a lot of depositors, not much use of those deposited assets. And you can see the purple line is the borrower's interest rate. So to borrow right now, you have to pay 2.5%. And if you deposit, which is the green curve, you only get 0.09%. So this is how much you earn by depositing. And you can actually play with this, and you can see that as more and more people borrow, as the utilization rate gets higher, the interest rates get higher as well. A high borrowing interest rate disincentivizes borrowing. A high depositing interest rate incentivizes more depositing. So this should put pressure to rebalance this utilization rate. And here are some of the market details. Let's see. What might be interesting here is, one is reserves. This is how much Ethereum is kept by the Compound protocol to use for emergencies. And this reserve is built up using the reserve factor. And this is the proportion of the interest that Compound keeps. So if the interest rate is 10% and the reserve factor is 2%, then Compound is keeping 2%. Sorry, let me say that again. So if the interest rate for borrowing is 10% and the reserve factor is 20%, then 2% of that 10% goes to Compound. So 20% of the interest paid by the borrower goes to Compound. The collateral factor is how much you can draw against this asset. So if you store, if you deposit Ethereum, how much can you borrow against this Ethereum that you're using as collateral? So if you store $100 of Ethereum, you can use $75 for other assets if you want to borrow other assets. And CETH, which is the C token. What else is important here? Here's exchange rate. So the CETH is part of the calculation in calculating this exchange rate. And the interest rate is also baked into the exchange rate.